Yes, my dear student. How are you all? Everyone fine? I am also doing great. Let us take one more chapter for MCQ discussion. In the last video, we have taken India's 103 business combination, and I hope you have listened it and you have understood the entire chapter from MCQ's point of view. We are targeting 30 out of 30 in MCQs. How many of you are targeting 30 out of 30? Just message me in the comment box. Got this? Before I start, once again, I just want to remind you that the PDF of this case study, both chapter wise and case study wise, is already uploaded in my Telegram channel. You can download the PDF of these MCQs from my Telegram channel. The link of the Telegram channel is given in the description of this video. Let us start the discussion. Can we start? Yes, sir. Coming to question number 1. ENG Limited prepare consolidated financial statement to 31st March each year. During the year ended 31st March 2018, the following event 1 to 5 affected the tax position of the group. In each event, identify the carrying amount and the tax base by selecting the appropriate option. So they ask you to find out carrying amount and tax base. Okay. L Limited, a wholly owned subsidiary of ENG Limited, incurred a loss adjusted for tax purpose of 30 lakh. L Limited is unable to utilize this loss against previous tax liability. So they are not able to utilize this loss from previous tax liability, means it cannot be carried backward. Of course, in India it can be carried forward. And the local tax legislation does not allow L Limited to transfer tax losses to other group company. Of course, it cannot be set up with the profit of any other group companies. Local legislation, however, allow L Limited to carry the loss forward and utilize it against its own future taxable profit. Of course, it can be carried forward and can be set up with future taxable profit. The directors of ENG Limited do not consider that L Limited will make taxable profit in the foreseeable future, but they are of the view that in future there will be no taxable profit. It means, can you say on these, of course, there will be some deductible temporary difference, and on that will not recognize any DTA, but they have asked carrying amount tax base. So carrying amount of such tax losses will be 0, and the tax base will be how much? 30 lakh. So there will be deductible temporary difference of 30 lakh. Understood? The option number, which one is correct? Option number B is correct. Carrying amount is nil and the tax base is 30 lakh. Understood? But on this, no DTA will be recognized. Why DTA will not be recognized? Because we do not have sufficient taxable profit. Question number 2. Just before 31st March 2018, ENG Limited committed itself to closing a division after the year end and making several employees redundant. Therefore, ENG Limited recognized a provision for closure cost of 20 lakh in its balance sheet as at 31st March 2018. Means we have applied India's 37 and we have created provision for restructuring, if you remember. So 20 lakh is the carrying amount of the liability. Local tax legislation allowed tax deduction for the closure cost only when the closure takes place. Means, can I say it will be allowed under Income Tax Act only when the actual restructuring takes place. It means the tax base will be nil. Tax base will be nil. In the year ended 31st March 2019, ENG Limited expect to make taxable profit which were well more than 20 lakh. Means, of course, can I say on this, because carrying amount of liability is more than tax base, therefore it will be deductible temporary difference. On that we can recognize DTA because we have sufficient future taxable profit, but they have asked carrying amount and tax base. On 31st March 2018, ENG Limited had taxable temporary difference from other sources which were greater than 20 lakh. This information are not relevant because they have asked you only carrying amount and tax base. So carrying amount will be 20 lakh and the tax base will be in option number A is correct. Option number A is correct. Chalega. Now coming to point number 3, during the year ended 31st March 2018, ENG Limited capitalized development costs which satisfy the criteria as per Ind AS 38. So they have recognized some intangible asset development expenditure has been capitalized. The total amount was capitalized 16 lakh. The development project began to generate economic benefit for ENG Limited for 1st Jan 2018. So it means this was available for use from 1st Jan 2018. Means the current year KNC will do amortization for how many months? 3 month amortization will be done. The directors of ENG estimated the project would generate economic benefit 5 years. The total useful life is 5 years. It means what is the amortization of current year? It is 16 lakh divided by 5 into 3 by 12. It is coming how much? 16 lakh divided by 5 into 3 divided by 12 means 80,000 is what? amortization. It means carrying amount become 15 lakh 20,000 is the carrying amount. Got this point? The development expenditure was fully deductible against taxable profit for the year ended 31st March 2018. It was fully allowed under income tax and therefore tax base become 0. The carrying amount become 15 lakh 20,000 and the tax base is nil. So option number C is correct. Option number C is correct. Chalega. Coming to point number 4. On 1st April 2017, the total goodwill arising on consolidation in ENG Limited consolidated balance sheet was 40 lakh. On 31st March 2018, the directors reviewed the goodwill for impairment and concluded that goodwill was impaired by rupees 6 lakh. There was no tax deduction available for any group company because of this impairment charge as at 31st March 2018. So you can see the goodwill carrying amount is how much? 40 lakh. And impairment loss is how much? 6 lakh. So 40 minus 6 how much? That is 34 lakh. 34 lakh. So 34 lakh is the carrying amount. And the tax base, because it is not, so they have given there no tax deduction available for any group. So tax base will be equal to nil. Tax base will be equal to nil. Now just try to understand, there was no tax deduction available for any group company because of this impairment charge as at 31st March 2018. It means, can I say, this is actually an item of permanent difference. So there are two ways to find out the deferred tax. There are two ways. So in this case, just try to understand, carrying amount is equal to 34 lakh. Tax base will be nil. Tax base will be nil. And you can see the difference is coming 34 lakh. But this difference will not be taxable. So no deferred tax on this. Either you can do in this way, or what we can do, this is 34 lakh, so tax base will be also equal to 34 lakh and temporary difference will be 0, and on this also no deferred tax. Means there are two ways to do this. Normally ICI follow this if they are asking MCQs. So whenever they are asking MCQs, follow this. So tax base for an item which is permanently disallowed, you need to find out tax base. However, for ease of reference, what we do, the tax base is equal to carrying amount for an item of permanent difference. Understood? So it should be 34 lakh and nil. But you can see the option is not given 34 lakh. Therefore, for this particular question, the best option will be 40 lakh. Means at the beginning of the year, it was 40 lakh and nil. Understood? So because the option of 34 lakh has not been given, therefore the best option become option number D. Carrying amount is 40 lakh and tax base is nil. Understood this point? You can see a note has been also given, the carrying value of goodwill before impairment has been considered. However, if suppose one more option has been given, 34 lakh and nil, that will be the best option before what? This option. Understood? So if that option is given, use 34 lakh and nil, because that option has not been given. The second best option is what? 40 lakh and nil. Got this point? Yes sir. I hope point number 4 you have understood. Chalega. Point number 5. On 1st April 2017, ENG Limited borrowed 1 crore. The cost of ENG Limited for arranging the borrowing is how much? 2 lakh. So transaction cost will be deducted. So 1 crore minus 2 lakh, it become, can I say, 98 lakh. 98 lakh. This cost qualified for tax deduction on 1st April 2017, means the transaction cost will be charged to taxable profit for that taxable purpose. Understood? The loan was for 3 years. No interest was payable on the loan. Means the contractual rate of interest is 0. But the amount repayable on 31st March 2020 will be this amount. So this is redeemable at premium. This equates to an effective annual rate of interest of 10%. So what is the effective rate of interest? 10%. So on this 10%, it will be 9,80,000. Contractual cash outflow will be 0. So 98 lakh plus 9,80,000. This become how much? 10 lakh. Means it become 1 crore 78 lakh. 1 crore 7 lakh 80,000. 1 crore 7 lakh 80,000. This become carrying amount, and the tax base will be equal to 1 crore only. So tax base will be equal to 1 crore. So carrying amount become 1 crore 7 lakh 80,000. 1 crore 7 lakh 80,000. So option number A is correct. Carrying amount is rupees 1.078 crore and the tax base is equal to 1 crore. Option number A is correct. Got this point? Yes sir. Now coming to question number 2. What they have given, A Limited has an item of PP whose cost is 10 lakh, is fully tax deductible. Deduction being given over a period shorter than the period over which the asset is being depreciated under Ind AS 16. Means under Income Tax Act, the useful life is less as compared to useful life under Ind AS 16. Correct? Got this point? They want to say that at the reporting that the asset has been depreciated to 5 lakh for financial reporting and 3 lakh for tax purpose. From my point of view, the option given is not correct. Let us first do without option. What should be the accounting base, tax base and the taxable temporary difference on the item of PP? Now what they have written at the reporting date, the asset has been depreciated to. So asset has been depreciated to, it means whatever is given 5 lakh and 3 lakh are the carrying amount tax base. Correct. It means the carrying amount become 5 lakh and tax base become 3 lakh. Understood? So carrying amount is more than tax base, this become taxable temporary difference, so it is 2 lakh. So from my point of view, the options will be 5 lakh and 3 lakh and 2 lakh, but you can see no such option has been given. No such option has been given. Now if you think that this 5 lakh and 3 lakh are depreciation, means the accumulated depreciation, because it has been given the asset has been depreciated by, means the, I think the wording should be the asset has been depreciated by rupees 5 lakh for financial reporting purpose and by rupees 3 lakh for tax purpose. Let us take that. So your carrying amount will be 5 lakh and the tax base will be 7 lakh. But can you say this will become deductible temporary difference? This will become deductible temporary difference. I hope you are understanding correct now. So in this case also there is no such option. So from my point of view, right now whatever option has been given, that is not correct. The option whatever given is not correct. From my point of view, this option is correct, 5 lakh, 3 lakh and 2 lakh. Now if you want to choose an option from these, so you can choose option number A, because if suppose this type of questions coming, if suppose they are asking this type of question where option is not correct, so I will say whatever you are thinking that you write down, because when you attempt then only you will get marks. If you are not attempting, no marks will be given for the wrong question. Correct now? So if suppose this question is wrong and if you are attempting it, then only some grace mark will be given. If you are not attempting it, no grace marks will be given. Understood? So either this is correct or this is correct, depending upon what information has been given. From my point of view, what they have written at the reporting date, the asset has been depreciated to rupees 5 lakh for financial reporting, means this is the carrying amount given, and 2 rupees 3 lakh for tax purpose, means this is the tax base given. So 5 lakh and 3 lakh become the carrying amount tax base and the taxable temporary difference will be 2 lakh. From my point of view, this will be the option, but no such option has been given. Coming to question number 3, the company has an identifiable asset QR with a carrying amount of 10 lakh. Its recoverable amount is 6 lakh 50,000. Its recoverable amount means impairment is there. So of course the after impairment loss, the revised carrying amount will become 6 lakh 50,000. The tax base is 8 lakh and the tax rate is 30%. Impairment loss are not tax deductible. Of course impairment loss is not allowed under income tax rate. Makers Limited expect to continue to earn profit in future. So they have sufficient taxable profit in future. For the identifiable asset QR, what would be the impact on deferred tax asset and deferred tax liability at the end of the period? So what is the carrying amount? Carrying amount is 6 lakh 50,000. What is the tax base? Tax base is 8 lakh, because carrying amount is less than tax base. This will be deductible temporary difference of how much? 1 lakh 50,000. 1 lakh 50,000 multiplied by what? 30%. It means there will be DTA of how much? 45,000. So DTA of 45,000 is correct. You can see DTA of 45,000. So option number D is correct. Got this point? And because we have sufficient taxable profit, therefore DTA of 45,000 can be recognized. Coming to question number 4. On 1st April 2018, the company issued convertible bond that mature in 5 years. The bond can be converted into ordinary shares at any time. Rainbow Limited has calculated the liability and equity component of the bond as 80 lakh and 80 lakh for liability component, 20 lakh for equity component. So it is a question of compound financial instrument. So as per India 32, we know that we will split compound financial instrument into equity and liability component. So 1 crore, the entire amount was how much? The proceed received was how much? 1 crore, and 1 crore has been the giving a total of bond of 1 crore. It has been split into 80 lakh and 20 lakh. Now in this question the market rate of interest has not been given, so we can't cross check. So they have given the splitting part. Of course that will be taken as correct only. The interest rate on the bond is 8%. This is the contractual rate of interest. Contractual rate of interest. Market rate of interest is not given. Local tax legislation allow a tax deduction for the interest paid in the cash. Means as per income tax, that whatever interest you are paying, that is only allowed for income tax purpose. The local tax rate is 30%. Now there is no question of compound financial instrument is given in India's 12 in ICS study material. So this is a question which I have taken from some other sources. So just try to understand what they want to say. As per books of account, what is the carrying amount of liability? Carrying amount of liability will be 80 lakh. Understood? And the tax base will be how much? 1 crore. The tax base will be 1 crore. Means as per income tax, we do not split. So tax base will be 1 crore. Understood? It means there is a temporary difference of how much? 20 lakh. Correct. Now this is a carrying amount, which is carrying amount of liability, which is less than tax base. So this will generate some taxable temporary difference. Carrying amount is less than tax base. So carrying amount is less than tax base for liability. This will be taxable temporary difference. On this will apply how much? On this apply 30%. So it means 6 lakh will be the deferred tax liability. The 6 lakh deferred tax liability will be created as at the beginning, means on the date of inception of the contract. So on 1/4/2018 will create a deferred tax liability of 6 lakh, which will be subsequently reversed. So it will be reversed subsequently in how many year it will be reversed? So it was how many year? 5 year. It will be subsequently reversed due to interest rate, because as per income tax, the interest will be as per contractual rate of interest. As per books of account, interest will be based on market rate of interest, so you can say effective rate of interest. Understood this point? I hope you have understood. However, if you want a full-fledged question of compound financial instrument for deferred tax calculation, just message me in comment box, then I will take one full-fledged question of compound finance instrument, how to create deferred tax liability and how to reverse it in subsequent period. However, there is no such question given in ICI study matter. If you want, just comment me in the comment box, sir, yes, do one question for compound financial instrument. But I hope you have understood this point. So deferred tax liability at the beginning on inception of contract will be how much? 6 lakh, and this will be created through equity, because this difference has been transferred. Means you can, the difference has been transferred to equity. Therefore, this DTA will be also created through equity. It will not be created through profit and loss account. So one more point they may ask, this 6 lakh will be created through PL or through OCI or through equity. So this will be through equity. Understood? So this will be the correct option. 6 lakh DTA will be created through other equity. Chalega? Yes, sir. 4 you have understood. Question number 5 come. PQI Limited measure is land using revaluation model under Ind AS. Because of revaluation gain, temporary difference have arisen on which deferred tax liability is required to be recognized. Okay, you are required to determine in which section of financial statement the debit effect of deferred tax liability should be given. Select the correct answer. So of course, whenever there is a taxable temporary difference due to revaluation gain, so revaluation gain has been transferred to OCI, so their tax effect will be also transferred to OCI. So deferred tax liability will be created through other comprehensive income. So answer is what? Option number B is correct. Got this point? Yes, sir. Coming next point, question number 6. QA Limited has purchased a machine during the current accounting period for rupees 2,50,000. Depreciation of 50,000 was charged in arriving the accounting profit for the current period. It means carrying amount become how much? 2 lakh. Carrying amount become 2 lakh. A deduction of 1 lakh was available under applicable tax law. So it means tax base become how much? 1,50,000. The remaining cost will be deductible in future period either as depreciation or as a deduction on disposal. Okay. The company also has a current asset of rupees 60,000 related to interest receivable. So they have given two part. They have some current asset which is nothing but interest receivable. So there is some interest receivable. The related interest revenue will be taxed on cash basis when it is received. So there was some interest receivable in books of account which will be taxed only when it is received. For the above, the difference between tax base of machine and the carrying amount will result into, so you can see carrying amount is more than tax base, so it will result in deferred tax liability. Correct? So it will result in deferred tax liability. So option number B is correct. You can see option number B is correct. So carrying amount of an asset is more than the tax base of an asset, so it will result in what? Deferred tax liability. Understood? Yes, sir. What will be the tax base of interest receivable and how will the same treated in the financial statement prepared under Ind AS? Give brief reasoning. Reasoning is not required now because reasoning will not be asked in FR paper. Reasoning, this question I have taken from GFRS. GFRM is Global Financial Reporting Standard, which was an elective paper in old scheme of syllabus, which is now deleted. So in your exam they will not ask reasoning. If they ask, you can give na. Yes, sir. Now they have a tax base, so it will be taxable only when it is received. So right now it is not received, so tax base will be nil, and carrying amount become how much? 60,000. Tax base become how much? Nil. So carrying amount is more than tax base, become taxable temporary difference 60,000, on which will create deferred tax liability. So answer which one is correct? Option number D is correct. Option number D is correct. Nil and deferred tax liability. Chalega. Nil and deferred tax liability. Got this point? Yes, sir. So this is also question. Now come to question number 7. Yes, sir. ABC Limited has the following balance included on its trial balance at 31st March 2017. Taxation 4,000 credit. So this is coming in trial balance and has a credit balance. It means it is a current tax liability. Current tax liability. And deferred tax liability 12,000 credit. This is deferred tax liability. Okay. The balance in the head taxation relate to an over provision from 31st March 2016. It means, can I say there was some liability created last year which is created in excess by how much? 4,000. So it will be considered as changes in accounting estimate. Means if the provision amount is, it is just like you have estimated some amount for last year and the actual amount may be different, so this will be considered as changes in accounting estimate. Okay. At 31st March 2017, the directors estimate that provision necessary for taxation on current year profit is 15,000. It means you need to create a current tax liability for current year. How much? 15,000 should be charged to your profit and loss account. Yes, sir. The carrying amount of ABC non-current exceed X. Sorry. The carrying amount of ABC Limited non-current asset exceed the written down value, means the tax base as per income tax, by rupees 30,000. If carrying amount is more than tax base, it will result in some taxable temporary difference. So there is a taxable temporary difference of how much? 30,000. On this the rate of tax is 30%. So 30% will be how much? 9,000. It means 9,000 deferred tax liability is required. What is the opening balance? Opening balance is 12,000. 12,000 now become 9,000. So deferred tax liability will be reversed by how much? So deferred tax liability will be reversed by 3,000. It means deferred tax liability is reversed. It means this become deferred tax income. So current tax, how much it will be debited? 15,000. Deferred tax liability reversed. So that will be 3,000 credited to PL. Understood? And can I say the last year current tax liability of rupees 4,000, that will be also reversed because that is due to changes in accounting estimate, and changes in accounting estimate will be done in the year when the accounting estimate change. Correct now. So 4,000 will be also reversed. 4,000 also will be reversed. So what they have asked? What is the charge for taxation that will appear in statement of PL for the year ended 31st March 2017? To 15 minus 3 minus 4 means 15,000 minus 7. How much? Is coming 15. 15 minus 7 is equal to 8,000. 8,000 will be charged to profit and loss account as a tax expense. As a tax expense. So 8,000, option number C is correct. Got this point? Have you understood this entire point? Yes, sir. Correct. Good question. It is a good question. I hope you have understood. Yes, sir. Coming to question number 8. An asset was acquired at a cost of rupees 1,50,000. The carrying amount is 70,000 after an impairment written down of rupees 30,000. So carrying amount is 70,000 after impairment write down of 30,000. So it means the carrying amount after impairment loss is 70,000 and cumulative depreciation of 50,000. So cumulative depreciation is of 50,000. You can see 1,50,000 minus 50 is 1 lakh minus 30 is equal to 70,000. Okay. The depreciation rate for accounting and the tax law is equal, means depreciation is same as per income tax book and as per accounting book. Impairment loss is not deductible for tax. The tax rate applicable is 30%. So carrying amount is how much? 70,000. And the tax base will be equal to 1,50,000 minus 50 means 1 lakh. It means there is a carrying amount is less than tax base. So there is a deductible temporary difference of how much? 30,000. On this will apply 30%, means will create DTA of how much? 9,000 DTA will be recognized. So DTA of rupees 9,000. So option number A is correct. Option number A is correct. Chalega? Yes, sir. Coming to question number 9. As part of the financial due diligence process, the directors of Ayushman Limited carried out fair value exercise to measure identifiable assets and liability of Basti Limited at 1st October 2001. So due diligence process means it is quite possible Ayushman Limited want to acquire Basti Limited. For that they have carried some due diligence process. The following matter emerged on the completion of the exercise. A property having a carrying amount of 50 million, depreciable amount is 30 million. So it is quite possible out of 50 million, 20 million belong to land portion and 30 million belong to building portion. Having a fair value of 70 million means land fair value is how much, carrying amount is how much. So land fair value is 20 million, and you can see out of 70, 33 million is for building. So 70 minus 33 is equal to how much? So 37 is the, sorry, fair value is equal to 37 million. Now fair value is equal to how much? 37 million, and the carrying amount is 20 million. The building, the fair value is how much? It is 33 million, and carrying amount is how much? 30 million. Understood this point? Yes, sir. The estimated future economic life of depreciable amount of the property as on 1st October 2001. As on 1st October 2001. Why? Because the date of acquisition was 1st October 2001. Correct? Is 30 years. So 30 years is the economic life, yeah, useful life you can say, for this depreciable building. The title of the property was still held by Basti Limited as on 31st March 2003. That is, this para is not at all relevant, because if they have acquired shares, the title may remain with the Basti Limited. Chalega? Yes, sir. Got this point? Plant and equipment having a carrying amount of 60 million. So there is a plant and equipment whose carrying amount is how much? 60 million. At an estimated fair value how much? 64 million. The estimated future economic life of the plant on 1st October 2001 was 4 years. So estimated useful life is how much? 4 years. Inventory having a carrying amount of how much? 30 million, and fair value is how much? 31 million. Fair value is 31 million, and the entire inventory is sold during the year. Entire inventory is sold during the year. This is nothing but the fair value adjustment which you used to do in consolidation chapter. Correct? The fair value adjustment have not been reflected in the individual financial statement of Basti Limited. In accordance with the group policy, the consolidated financial statement of fair value adjustment will be regarded as a temporary difference for the purpose of computing deferred tax. Okay, so for the purpose of consolidated financial statement, what they are saying, the fair value gain or loss will be considered as temporary difference. The rate of tax is 20%. What should be the deferred tax amount in the CFS of Ayushman Limited as on 31st March 2003? So they want on which date? As on 31st March 2003. Good question, very good question. So let me first explain you. So what they have given? If for land, building, property, plant and equipment, and inventory, what is the fair value? First, can you give me fair value? So fair value is how much? It is 37 for land, 33 for building, for plant and equipment, what is the fair value? 64, and inventory, what is the fair value? 31. Then carrying amount is how much given? It is 20 for land, 30 for building, 60 for plant and equipment, and 30 for what? Inventory. So what is the fair value gain? Fair value gain, it is coming 17, 3, 4, 1. Then can you say we'll also give some additional depreciation or additional expense during the post acquisition period? The date of acquisition was 1st October 2001, and the year end is 31st March 2000. 31st March 2000. What is the year end? 31st March 2003. Correct? Now it means, can I say it is 1.5 year? Post acquisition period is 1.5 year. It means you need to calculate additional depreciation of 1.5 year. So this is 3. So 3 divided by 30. 30 is the economic life into 1.5. It is coming how much? Additional depreciation which will be charged to post acquisition period will be 0.5. 0.15. Similarly 4. And what is the economic life of property, plant and equipment is 4 years. So divide by 4 into 1.5. So additional depreciation will be 1.5, and this is entirely sold. It is entirely sold. So there will be some additional cost of sales during the post acquisition period. Understood? So what is the net changes? Net changes means net increase on the date of consolidation. This remains 17. This is 3 minus 1.5, that is 1.5. This is 4 minus 1.5, that is 2.5, and this is 0. Understood? It means this fair value gain will become the taxable temporary difference on the date of acquisition. What is the taxable temporary difference? This 17 plus 3 plus 4 plus 1. So 25 is the taxable temporary difference on the date of acquisition, but the 17 plus 1.5 plus 2.5 plus 0, that become the taxable temporary difference on the date of consolidation. So 17 plus 1.5 plus 2.5, that is become 21. 21, understood? Correct now? A minute. 20. Correct. Okay. Okay, sir. This much you have understood. So this is coming how much? 21. Divide, that is 0.1. This is 3 minus 0.15 is equal to what? 2.85. 2.85. Okay. 2.85. That is coming how much? 17 plus 2.85 plus 2.5 is coming 22.35. So this become taxable temporary difference at year end, which got reversed due to additional expense during the post acquisition period. So they have asked DTL at year end. DTL at year end means on the date of consolidation. So we'll apply what is the rate of tax. The rate of tax they have given how much? 20%. The 20% of this is how much? So into 20%, that is coming 4.47. So 4.47 is the deferred tax liability on the date of consolidation. On the date of consolidation, so option number D is correct. If suppose they ask how much is reversed during the post acquisition period, so first calculate on 24 into 20%, how much? 4.8 now become 4.47. So this is the reversal of deferred tax liability during the post acquisition period, and this, which will be reversed through what? Post acquisition profit. But created means whenever we create deferred tax liability, that will be adjusted with goodwill or gain on bargain purchase on the date of acquisition. Understood this point? So this, whatever you are creating deferred tax liability on the date of acquisition, that will be created by doing adjustment in goodwill or gain on bargain purchase on the date of acquisition. But whatever reversed during post acquisition period, that reversed due to additional expense due to during post acquisition period, because that has been transferred to profit and loss account, the deferred tax reversal will be also through post acquisition profit. But they have marked deferred tax liability on 31st March 2000, 31st March 2000, correct now, 31st March 2003, that will be 4.47. So your answer is deferred tax liability 4.47. Very good question, can be asked in exam for 2 marks. 2 marks, lot of calculation is required. Now question number 10, changes to deferred tax arising from business combination impact. Right now I have said that changes to deferred tax arising from business combination on the date of acquisition will be adjusted through goodwill only. So option number C is correct. Question 11, during the year ended 31st March 2001, G Limited has acquired 60% shares of Global in accordance with Ind AS 103. Goodwill arising on acquisition subsidiary amounted to rupees 20 lakh. The tax rate applicable for G Limited 30%. The deferred tax liability relating to goodwill will be nil, because can is a goodwill, if question is silent, always assumed to be what? Not deductible for tax purpose. Means it is not deductible for tax purpose. It is an item of permanent difference. So on initial recognition of goodwill will not recognize any deferred tax. So the answer is 0. Option number 4, 0 is the correct option. Understood this point? Yes, sir. Coming to question number 12, Star Limited expect that it will earn a minimum of 250 lakh per annum for the anticipated future and will subject to 30% tax. Means they are saying that future taxable profit is available. It means DTA can be recognized. A liability of 50 lakh in respect of accrued product warranty cost has been recognized by Star Limited. So there is a liability of 50 lakh. Carrying amount of liability is 50 lakh. For tax purpose, the product warranty cost will be deductible when the entity claim or incur the cost. Means the tax base right now will be nil. Now carrying amount is more than tax base. For liability, it become deductible a temporary difference of 50 lakh. 50 lakh into 30% means you'll create a DTA of how much? 15 lakh. DTA of 15 lakh will be recognized. So option number 1 is correct. DTA of 15 lakh will be recognized because we have future taxable profit. DTA can be recognized. Correct? Yes, sir. Coming to question number 13, entity A has calculated taxable temporary difference of 50 lakh and deductible temporary difference of 20 lakh on separate item. The tax rate for current year is 35%. However, the tax rate in the previous year is 30%. It is expected that future tax rate would be 40%. Now, what should be the measurement? Is what rates to be used for the measurement of DT and DTL? So can you see it is based on the current tax rate. If the future tax rate is known to you, means the tax means the finance act has been enacted, or it is virtually certain that it will be enacted by the end of reporting period, then we can take the future tax rate. But nothing has been given here. It is given it is expected, which is not virtually certain, therefore in this case the answer is 35%. However, if in the question it is given that it is expected in future the tax rate would be 40%, which is virtually certain by the end of reporting period, correct, then means the enactment is substantive, then it will be taken as 40%, but nothing has been given. The correct option will be 35%. Okay, yes sir. Question 14, to calculate tax base of liability for employee benefit, which one of the following formula would be used? For tax base of liability, the formula is what? Carrying amount minus any amount which is deductible in future, so you can see the correct option is what? Carrying amount. This is not correct. Carrying amount, this is also not correct. Carrying amount, this is also not correct. So carrying amount minus future deductible amount is carrying amount less any amount which is deductible for tax purpose, plus future taxable amount, means any amount which is taxable in future, that will be added. Any amount of that liability which is taxable in future, that will be added. For example, right now we have done one question of compound financial instrument. In that question, what was the carrying amount? 80 lakh. What was the tax base? 1 crore. This was the question. Now just try to understand, if the liability is settled today only at 80 lakh, so 20 lakh become gain, and that 20 lakh will be taxable in future. Therefore, the tax base become carrying amount 80 lakh plus 20 lakh. 80 lakh plus 20 lakh. So this answer is correct. Carrying amount minus future deductible amount plus future taxable amount. Understood? Have you understood this point? Means I have explained why we'll add future taxable amount. So I have explained with the compound financial instrument one question. In that question, carrying amount was 80 lakh, tax base was 1 crore. Why we have taken 1 crore? Because carrying amount is 80 lakh plus 20 lakh is taxable in future. Why 20 lakh is taxable in future? If the liability is settled as on today at 80 lakh, liability is today settled at rupees 80 lakh, so there is a gain of what? 20 lakh, and that gain will be taxable in future, taxable under income tax act. Therefore the tax base will become 80 lakh plus 20 lakh. I hope you have understood option number 4. Option number 4 is correct. Got this point? Yes sir. Coming to question 15, as per AS 22 on accounting for taxes on income, the tax base. So as per AS 22, you can say as per Ind AS 12 only, because this question will not be asked as per accounting standard. This question will be asked as per Ind AS 12. It will be current tax plus deferred tax charged to PL account, current tax minus deferred tax credited to PL account. Both are correct. I always say that read all option carefully. If you say option number A is correct, by only reading option number A, you may be wrong. So option number C is correct, either A or B. Either deferred tax will be deferred tax expense, or deferred tax will be deferred tax income. So it will be current tax plus minus deferred tax. Current tax plus minus deferred tax. Understood? So option number C is correct. Yes sir. Coming to question 16, state which of the following statement are correct. There is no precondition required to recognize deferred tax liability. Correct? Can is deferred tax liability can be recognized on all taxable temporary difference without any condition. DTA under all circumstances can only be created if and only if there is a probability of sufficient future taxable income arise. This is also correct. Both A and B are correct. So both are correct. Option number A is correct. Chalega? Yes sir. Coming to question number 17, Wealth Limited has an identifiable asset QR with a carrying amount of 20 lakh. Its recoverable amount is 13 lakh. So it means carrying amount after impairment loss is 13 lakh. Similar question we have done right now. The tax base is how much? 16 lakh. So carrying amount is less than tax base. So this is deductible temporary difference of how much? 3 lakh. 3 lakh into 30%. 3 lakh into 30% means 90,000. So we'll create DTA of rupees 90,000. Understood? Have you understood this much? 1 minute. Now come to question number 18. Yes sir. Wealth Limited is proposing to acquire Health Limited, which is currently following Indian GAAP other than the company's Indian Accounting Standard Rules 2015. Means they were following accounting standard. We can say in this way. Health Limited does not have taxable income as per the applicable tax law but pays minimum alternate tax based on book profit. The tax paid under MAT can be carried forward for the next 10 years as per the Health Limited projection submitted to his banker. It is in the position to get credit for the same by the end of 8 years. So if you remember, we have discussed under India's 12 that if there is MAT credit, for that we recognize deferred tax asset, and if it is possible to get credit, then DTA can be recognized. Health Limited is recognizing MAT credit as a current asset under Indian GAAP. Means as per accounting standard AS22 is silent for recognition of deferred tax on MAT credit. But there is one guidance note. Guidance note says that it is just like an advance tax to create a current tax for MAT credit. Understood? So the amount of MAT credit as on 31st March 2021 is 20 crore and as on 31st March 2022 is 15 crore. Management is looking for the clarity on how this would be impacted upon the conversion of Health Limited financial statement to Ind AS once the acquisition goes through. In relation to the Health Limited, how the MAT credit recognized upon conversion to Ind AS. So can I say MAT credit will recognize a deferred tax asset? Option number B is correct. Option number B is correct. No doubt about that. So in relation to Health Limited, what is the deferred tax asset or deferred tax liability impact on account of MAT in the books of Health Limited for the year 2021-2022? So can I say we have understood that MAT credit at year end will be 15 crore, and initially because of accounting standard we have not recognized any we have not recognized any deferred tax asset. So there will be increase in deferred tax asset by 15 crore because there is no MAT credit, there is no deferred tax which was created as per accounting standard. We have created one current asset but not deferred tax asset. So deferred tax asset will be increased by 15 crore for the current year. So there will be increase of DTA by 15 crore. So option number B will be correct. Option number B will be correct. Understood this point? Here you can do mistake. You will say that there will be increase or decrease by 5 crore. That is not correct. So the changes is not 5 crore. For income, for as per accounting standard, no deferred tax asset was created. As per Ind AS, we need to create deferred tax asset at year end by 15 crore. So there is an increase in DTA by 15 crore. Chalega? Yes, sir. Coming to question 19, Delicious Limited revalue the packing plant for rupees 1 crore to 1.5 crore and created deferred tax liability of 5 lakh. But the accountant did not record this in the account. Which of the following is the correct accounting treatment for deferred tax liability? So deferred tax liability will be created through OCI by debiting OCI revaluation surplus. So debit other comprehensive income, revaluation is up by 5 lakh. This option number C is correct. Coming to question number 20, Newgen Limited also has an asset AS which cost rupees 2 lakh. On 31st March 2017, the carrying value was 1,80,000 and asset was revalued to 2,20,000. So after revaluation, what is the carrying amount? 2,20,000. No adjustment is made for tax purpose. Cumulative depreciation for tax purpose is 30,000. It will be 2 lakh minus 20,000 means how much? Minus 30,000 means what? 1,70,000 will be the tax base. So there will be taxable temporary difference of how much? 50,000 will be the taxable temporary difference. What are the deferred tax implication of this transaction in case of asset AS? So we need to create deferred tax liability on 50,000. 50,000 into 30% means 15,000. So deferred tax liability of rupees 15,000 will be created. Option number B will be correct. Got this point? Yes, sir. Coming to question 21, the entity has an identifiable asset Asota with a carrying amount of 10 lakh and is recoverable amount 6,50,000. Similar question we have done. The tax base of Asota is 8 lakh, so 6,50,000 after impairment become the carrying amount. The tax base is 8 lakh. This is very popular question in MCQ. This type of question can be asked. So you can see there is a deductible temporary difference of 1,50,000. 1,50,000 into 30% means 45,000. So we should create a DTA of 45,000 and they have given entity expect to continue earn profit in future, so we can recognize DTA of 45,000. Correct? Understood. So option number C is correct. Option number C is correct. Coming to question 22. PQR Limited, a manufacturing company, prepare consolidated financial statement to 31st March every year. During the year ended 31st March 2018, the following event affected the tax position of the group. The rate of corporate tax is 30%. Same question we have done. The question number 1 is similar, but in question number 1 they have asked carrying amount and tax base. In this they will ask the deferred tax asset or deferred tax liability. So similar question, but the demand is different. Oh, QPR is a wholly owned subsidiary of PQR Limited, incurred a loss adjusted for tax purpose 30 lakh. QPR Limited is unable to utilize this loss against the previous tax liability. Income Tax Act does not allow QPR Limited to transfer a tax loss to other group company. However, it allows QPR Limited to carry forward the loss and utilize it against company's future taxable profit. The directors of PQR Limited do not consider that QPR Limited will make taxable profit in the foreseeable future. So of course can I say on unused tax losses will create deferred tax asset, but deferred tax asset can be recognized only when we have sufficient future taxable profit against which such tax losses can be utilized. Correct? So in this case DTA should be created but no DTA will be recognized. So option number C, no DTA would be recognized, is the correct answer. Chalega. Point number B. During the year ended 31st March 2018, PQR capitalized the development cost which satisfy the criteria as per Ind AS 38. The total amount capitalized was 60 lakh. The development project began to generate economic benefit for PQR from 1st Jan 2018. The directors of PQR estimated the project would generate economic benefit for 5 years. So because it was available for use from 1st Jan 2018, 3-month depreciation will charge and 3-month depreciation will be equal to 80,000. You can calculate for 5 years. Correct. Useful life is 5 years. So 16 lakh minus 80,000 will be 15 lakh 20,000 will be the tax base. The development expenditure was fully deductible against taxable profit for the year, so the tax base will be 0. Therefore, can I say carrying amount is more than tax base, so there will be taxable temporary difference of 15 lakh 20,000. 15 lakh 20,000 into how much? The tax rate is 20%. 30%. So 15 lakh 20,000 into 30%. How much? 4 lakh 56,000 is the deferred tax liability. So deferred tax liability would be 4 lakh 56,000. Option number B is correct. Chalega? Yes, sir. Then point number C, on 1st April 2017, the PQR borrowed 1 crore. The cost to arrange the loan is 2 lakh. It means it become 98 lakh, 1 crore minus 2 lakh. This cost qualified for tax deduction on 1st April 2017. The loan was for 3-year period. No interest was payable. However, the effective rate of interest 10%. Amount redeemable is this amount. As per income tax, a future tax deduction of 30 lakh 43,800 will be claimable only when the loan is repaid. So in this, the carrying amount will be how much? Can I say 98 lakh was the initial recognized amount? In this will add 10% effective interest 9 lakh 80,000. So carrying amount will become 98 lakh plus 9 lakh 80,000 means 1 crore 7 lakh 80,000 and the tax base will be equal to 1 crore. So 78,000 will be the temporary difference because carrying amount is more than tax base. This will be deductible temporary difference, deductible temporary difference. So 78,000 into 30%. 1 minute. 98 lakh plus 9 lakh 80,000. It is 1 crore 7 lakh 80,000. 7 lakh 80,000 is the, not 78,000. It is 7 lakh 80,000. 7 lakh 80,000 into what? 30%. So into 30% how much? 7 lakh 80,000 into 30% is 2 lakh 34,000. So we should recognize a deferred tax asset of 2 lakh 34,000. So option number A is correct. Option number A is correct. Chalega? Understood? Very simple. Come to question 23. The last question, I think so. Yes, sir. K Limited prepare consolidated financial statement to 31st March each year. During the year ended 31st March 2002, K Limited entered into the following transaction, assume tax rate to be 25%. On 1st April 2001, K Limited purchased an equity investment for 2 lakh. Okay. The investment was designated at fair value through other comprehensive income. On 31st March 2002, the fair value is 2 lakh 40,000. In the tax jurisdiction in which K Limited operate, unrealized gain and loss arising from revaluation of investment of this nature are not taxable unless the investment is sold. It means, can I say, carrying amount become 2 lakh 40,000, tax base become 2 lakh, Therefore, carrying amount is more than tax base. So taxable temporary difference of 40,000, and 40,000 into 25%, 10,000 is the deferred tax liability, and this deferred tax liability will be created to PL or OCI, because this gain or loss is transferred to OCI. Therefore, deferred tax will be also transferred to OCI. So correct answer will be deferred tax liability would be 10,000 through OCI. Option number D is correct. Option number D will be correct. Chalega? Yes, sir. Point number B. On 1st August 2001, K Limited sold product to A Limited, a wholly owned subsidiary operating in the same tax jurisdiction as K Limited, for rupees 80,000. The goods had a cost of K Limited for 64,000. Correct? By 31st March 2002, A Limited has sold 40% of these goods, selling the remaining during next year. Now just try to understand what is the unsold goods. Unsold goods will be 40%. 40%. So can you say the carrying amount will be after eliminating URP? After eliminating URP. So you can see the profit is how much? 80 minus 64,000. Understood? So 60% remain unsold. 40% sold, so 60% remain unsold. So 16,000 ka 60%. So your unrealized profit is 9,600. 9,600. Correct? And 80,000 is the cost price for the for which company K Limited sold product to A Limited. So in the books of A Limited, the cost price will be 80,000. This include profit of K Limited. Understood? Yes, sir. So 80,000 into 60%, that is coming 48,000 minus 9,600. This will become carrying amount, but as per tax base, this will not be eliminated. So tax base will remain same, and therefore in this case you can see carrying amount of the inventory will be less than tax base by rupees 9,600. By rupees 9,600. So there will be deductible temporary difference of 9,600, on which will create a deferred tax asset of 25%. So 9,600 into 25% means 2,400. So deferred tax asset would be 2,400 through PL. Through PL, of course, through PL. So DTA will be recognized. That will be 2,400. Means simple. Calculate unrealized profit. On unrealized profit, you create DTA. Understood? You create DTA. So unrealized profit is 9,600. That will be the deductible temporary difference, on which will create DTA of 2,400. So DTA would be created of rupees 2,400 through PL. So option number A is correct. Come to point number C. On 31st October 2001, K Limited received 2 lakh from a customer. This payment was in respect of service to be provided by K Limited from 1st November to 31st July. K Limited recognized the revenue of rupees 1,20,000 in respect of this transaction for the year ended 31st March 2002. So out of 2 lakh, how much revenue recognized? 1,20,000. So what is the pre-receive income? Pre-receive income become how much? 80,000. So this become advance income. Pre-receive income is liability. Will recognize the remainder in the year ended 31st March 2003. Means it will be recognized as an income in the next year. Under the tax, income tax in which K Limited operate, 2 lakh received on 31st October 2000 was included in the taxable profit. Means it will be taxed on cash basis under income tax act. So can you say tax base will become, carrying amount is 80,000. Tax base will become nil. Tax base will become nil because it is already taxed. It is already taxable once the cash is received. Understood? It means carrying amount is more than tax base for a liability. So this will result in what? Deductible temporary difference of rupees 80,000, on which 25% means how much? 20,000 is DTA, and DTA will be created through profit or loss. So DTA of 20,000 will be created through profit or loss. So option number A is correct. Option number A is correct. Understood? With this we completed the entire discussion of Ind AS 12. I hope this will help you. I hope this will help you and you have understood each and every point. These MCQs are very important. So just once you practice all the MCQs, whatever we are discussing, because out of this there is a high probability one of the question may come or similar question may come. If you can get 30 out of 30, believe me, your marks will be super marks from CA examination point of view. Right score 30 out of 30. Just comment in the comment box. Have you understood the entire Ind AS 12 MCQs or not? Are you liking this type of discussion or not? And which chapter you want in the next recording, means next video, which chapter you want for MCQ discussion? Just comment in the comment box. We'll come with that chapter only. Thank you very much for today. Bye bye. Take care. All the best for your preparation. Bye bye.